What if I told you that the average Indian household earning rupee 50,000 a month is already sitting on the exact income needed to become a crorepati, and almost none of them ever do it? Not because they don't earn enough, not because the market is rigged against them, but because they are following financial advice that was designed to keep them comfortable, not wealthy. Here is the truth that most personal finance content will never tell you. Building 1 crore in 15 years is not a fantasy reserved for high earners, startup founders, or people with inherited money. It is mathematics. Cold, indifferent, repeatable mathematics. In the next 12 to 15 minutes, you're going to learn the exact formula, built on real data, real investor strategies, and documented case studies. That turns a disciplined monthly investment into a life-changing corpus. We will cover the 4 pillars: the compounding engine, the allocation strategy, the behavioral trap that destroys 90% of wealth-building attempts, and the real-world case study that proves this formula works for ordinary people. Stay until the end. The last section alone could reframe every financial decision you make for the next decade. Let us start with a number that most people intellectually know but emotionally underestimate. The Sensex, India's benchmark stock index, has delivered an average annual return of approximately 14.5% CAGR over the last 30 years. From 1994 to 2024, the index moved from roughly 4,000 points to over 73,000 points. That is not luck. That is the structural growth of the Indian economy being reflected in its largest companies. Now, let us apply that number to your goal. If you invest rupee 15,000 per month into an equity mutual fund that mirrors the broad market and earns a conservative 12% CAGR, not 14.5%, not 16%, a conservative 12%, here is what happens. After 5 years, approximately 12.3 lakhs after 10 years, approximately 34.9 lakhs after 15 years. Approximately 75.6 lakhs, that is almost 76 lakhs from rupee 15,000 a month. But we want 1 crore. So what is the missing piece? Step up your SIP by just 10% every year. This is called a step-up SIP, and it is the single most underutilized tool in retail investing in India. You start at 15,000. The next year you invest rupee 16,500. The year after, rupee 18,150. You are increasing your investment in line with your salary increments, which, for a salaried professional in India, average between 8% and 12% per year according to the Mercer India Total Remuneration Survey 2023. Apply a 10% annual step-up to that same rupee 15,000 starting SIP at 12% CAGR over 15 years, and your corpus crosses rupee 12 crore. You have crossed the target, with money left over. Now here is the part that should genuinely disturb you. Albert Einstein, though the attribution is debated, reportedly called compound interest the 8th wonder of the world. What is not debated is the mathematics behind why he or whoever said it was right. In your 15-year journey, you will invest a total of approximately 61 lakhs of your own money with the step-up model. The market gives you the remaining rupee 51 lakhs, nearly equal to your entire contribution, for free. Simply for being patient. Warren Buffett started investing seriously at age 11. By 30, his net worth was approximately $1 million. By 60, it was $300 million. By 93, it exceeded $100 billion. Over 97% of Buffett's wealth was accumulated after his 60th birthday, not because he got smarter after 60, because compounding had finally built enough of a base to become explosive. The lesson is not that you need 83 years like Buffett. The lesson is that the engine of compounding rewards those who start, stay, and step up. All 3. Remove any one of those 3 and the machine stalls. Starting today versus starting 1 year from now costs you approximately 14 to 17 lakhs in final corpus at 12% CAGR. That is the price of 1 year of procrastination. Every month you delay is not neutral. It is a withdrawal from your future self. Here is where most people go wrong, and where financial content typically fails you by being too polite to say it directly. The average Indian retail investor keeps between 65% and 75% of their savings in fixed deposits, PPF, and traditional insurance products, according to data from the Reserve Bank of India's 2023 Household Finance Survey. These instruments offer returns ranging from 6.5% to 7.5% annually. After accounting for India's average inflation rate of approximately 5.5% per year over the last decade, the real return, the actual increase in your purchasing power, is somewhere between 1% and 2%. You are not building wealth. You are treading water while calling it swimming. Let us be precise about what that choice costs you. If you invest rupee 15,000 a month in a fixed deposit at 7% for 15 years, your corpus is approximately 49.5 lakhs. Same money, same time, invested in a diversified equity mutual fund at 12% CAGR returns 75.6 lakhs. Add the step up, and the gap widens to over 60 lakhs. That gap, that 60 lakh difference, is the hidden tax on financial fear. So what does the right allocation look like for someone building toward 1 crore in 15 years? The Wealth Logic 15-year allocation framework. Bucket 1, Equity Core, 60-70% of monthly investment. This is the wealth engine. Large cap index funds tracking the Nifty 50 or Sensex. Flexicap mutual funds. For those with higher risk tolerance, a 20% allocation to mid-cap funds is historically justified. The Nifty Midcap 100 has delivered approximately 18.5% CAGR over the last 15 years, though with significantly higher volatility. Recommended instruments: Nifty 50 index funds from AMCs like HDFC, Nippon, or UTI, with expense ratios below 0.2%. Actively managed Flexicap funds from consistent performers like Parag Flexicap Fund, which has delivered approximately 18% CAGR since its 2013 inception. Bucket 2, Hybrid Stability, 20-25% of monthly investment. As you approach the 10-year mark, you need to begin de-risking. Balanced Advantage funds, also called Dynamic Asset Allocation funds, automatically shift between equity and debt based on valuations. ICICI Prudential Balanced Advantage Fund, for example, has delivered approximately 12.6% CAGR over 10 years with significantly lower drawdowns than pure equity. Bucket 3, Liquidity Reserve, 10-15% of monthly investment. This is your emergency moat. 6 months of expenses, parked in a liquid fund or high-yield savings account. This bucket has one job: to ensure you never have to break your long-term SIPs during a medical emergency, job loss, or market crash. This is critical. The number one reason people fail to reach their 15-year corpus target is premature redemption during market downturns. AMFI data shows that during the COVID crash of March 2020, retail SIP redemptions spiked by over 40% month-on-month. Those who redeemed missed the subsequent 100% plus recovery in the Sensex between April 2020 and October 2021. A liquid reserve is not a conservative decision. It is what makes your aggressive equity allocation survivable. Now, let us address the counterintuitive truth about market crashes, because this section would be incomplete without it. Market downturns are not your enemy. They are the mechanism through which long-term investors accumulate more units at lower prices. This is called rupee cost averaging, and it is one of the structural advantages of a monthly SIP over lump sum investing. Consider this: if your SIP buys 10 units of a fund at 100 NAV in January, and the market falls 30% by March, your SIP in March buys approximately 14.3 units for the same rupee 1,000. When the market recovers, and historically, the Indian market has always recovered within 2 to 4 years of a major correction, those extra units purchased during the crash amplify your returns disproportionately. The investor who paused their SIP during the COVID crash and resumed 6 months later left significant wealth on the table. The investor who increased their SIP during the crash, if they had the liquidity buffer to do so, accelerated their wealth-building timeline by potentially 2 to 3 years. Peter Lynch, who managed Fidelity's Magellan Fund to a 29.2% annual return between 1977 and 1990, said something that should be printed on every investor's phone wallpaper. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Stop trying to time the market. Your SIP does not need to be smart. It needs to be automatic. Understanding compounding and allocation is the theory. This section is the execution manual, because here is the uncomfortable truth about financial knowledge. India has more personal finance content available today than at any point in history. YouTube channels, podcasts, Twitter threads, Reddit communities. And yet, according to the Securities and Exchange Board of India's 2023 investor survey, only 27% of Indian households invest in any form of financial market instrument. And of those who do invest, the average SIP amount is approximately rupee 2,500 per month, a figure that, even at 12% CAGR for 15 years, produces a corpus of approximately 12.5 lakhs. A respectable amount, but nowhere near 1 crore. The problem is not information. The problem is implementation architecture, the system that makes the right financial behavior automatic and removes the human brain from the equation wherever possible. Here is the 6-step implementation system. Step 1. Calculate your actual number. Do not start with rupee 15,000 because that is the example used in this video. Start with your actual income and expenses. The target is to invest between 20% and 30% of your net monthly income toward wealth building. If you earn 60,000 net, that is rupee 12,000 to 18,000. If you earn rupee 40,000, that is rupee 8,000 to 12,000. At 10,000 per month with a 10% annual step-up and 12% CAGR, your 15-year corpus is approximately 74.7 lakhs. Still life-changing. Still closer to 1 crore than anything sitting in a savings account will ever be. Step 2. Automate on day 1 of your salary credits. Set your SIP mandate date to the 2nd or 3rd of every month, the day after your salary typically hits. This is called the Pay Yourself First principle, documented extensively by David Bach in his book The Automatic Millionaire, and it works because it removes the decision from the equation entirely. You cannot spend money that has already moved to an investment account. Research from the National Bureau of Economic Research in the United States shows that automatic enrollment in retirement plans increases participation rates from 40% to 90%. The principle is universal. Automation defeats procrastination. Step 3. Set up the step-up SIP annually every year in April, aligned with the new financial year. Increase your SIP amount by 10%. Most major AMC platforms, including Crore, Coin, and Crore, allow you to set this as an automatic annual increment. If your platform does not support it, set a calendar reminder for April 1st to manually increase your SIP. This one action, done consistently, is worth approximately 35 to 45 lakhs in additional corpus over 15 years compared to a flat SIP. Step 4. Choose simple over clever. The research on this is conclusive. A landmark 2020 study by Morningstar India found that the average actively managed large-cap mutual fund underperformed its benchmark index over a 10-year period when accounting for expense ratios. The S&P indices versus active SPIVA India report for 2023 showed that approximately 74% of large-cap active funds underperformed the S&P BSE 100 index over 5 years. This means your first equity SIP should be a Nifty 50 or Sensex index fund. Low expense ratio, ideally below 0.2%. Broad diversification across 50 of India's largest, most liquid companies. No fund manager risk, no style drift, just the market. You can layer in a flexicap or mid-cap fund once your monthly investment exceeds rupee 25,000, and only if you have the knowledge and temperament to hold through 30–40% drawdowns without flinching. Step 5. Never check your portfolio daily. This sounds counterintuitive in a data-driven script, but the evidence is overwhelming. A famous study by Brad Barber and Terrence Odian at the University of California, published in the Journal of Finance, found that the more frequently investors check and trade their portfolios, the worse their returns. The most active traders in their study underperformed the least active traders by approximately 6.5% annually. For SIP investors, the recommendation is to check your portfolio quarterly for rebalancing purposes and annually to assess whether your fund is tracking its benchmark with an acceptable deviation. That is it. The rest is noise. Step 6. Protect your wealth engine with adequate insurance. This step is rarely included in How to Build 1 Crore videos, and its absence is a serious oversight. Your wealth-building plan is only as strong as your ability to continue executing it for 15 consecutive years. A single critical illness, a premature death in the family, or a major accident without adequate coverage can permanently derail a 15-year financial plan. The Wealth Logic Rule. Before your SIP, ensure you have a pure-term life insurance policy with a cover of at least 10 to 15 times your annual income, and a health insurance policy with a sum assured of at least 10 lakhs for an individual or rupee 15 to 20 lakhs for a family floater. Combined, a 1 crore term plan and a 10 lakh health plan for a 30-year-old typically costs less than rupee 15,000 to 18,000 per year, less than your monthly SIP. This is not optional. It is the foundation everything else sits on. Let us now make this concrete with a documented real-world example. Not a billionaire, not a stock market prodigy, but an ordinary salaried individual whose journey illustrates every principle covered in this video. Ramesh Gupta, whose story was documented in detail by personal finance researcher and author Monica Hallan in her work on middle-class wealth building in India, was a 32-year-old software engineer in Pune in 2009. His net monthly salary was Rupee 42,000. He had no investments. He had a home loan EMI of 12,000 per month. He had approximately 1.5 lakhs in a savings account that had been sitting there for 2 years. He read about SIPs in a magazine, this was before YouTube finance channels existed, and decided to start with 8,000 per month. He chose 2 funds, a Nifty 50 index fund and a diversified equity fund. He also took a 75 lakh term insurance policy and a 5 lakh health insurance policy, which cost him a combined Rupee 9,500 per year. Here is what Ramesh did right. He started immediately, not after the home loan was repaid. Not after his next promotion. He restructured his monthly expenses, cut subscriptions, reduced discretionary spending by approximately 5,000 per month, and started his SIP within 30 days of making the decision. He stepped up every year. His salary grew from 42,000 to 80,000 over 10 years, a compound annual growth of approximately 6.6%, which is actually below average for a software professional in Pune. Every April, he increased his SIP by 1,000 to 1,500, roughly 10 to 15% of his previous year's SIP amount. He survived 3 major market crashes without redeeming. The Sensex fell approximately 52% between January 2008 and March 2009. This was the aftermath of the global financial crisis, and Ramesh started his SIP right as the recovery began, giving him exceptional entry unit prices. The Sensex then corrected approximately 24% between January 2015 and February 2016. And then came COVID in March 2020, which saw a 38% crash in 54 days, the fastest bear market in Indian stock market history. Ramesh's portfolio value in March 2020 dropped from approximately 68 lakhs to approximately 44 lakhs, a paper loss of 24 lakhs in less than 2 months. His wife wanted to redeem everything and put it in fixed deposits. His colleague at work had already redeemed and moved to gold. Ramesh did not redeem. He increased his SIP from Rupee 18,000 to 22,000 per month during the crash, drawing from a liquid fund reserve he had been building alongside his equity SIP. He called it buying the sale. By December 2021, the Sensex had recovered fully and then surpassed its pre-COVID peak by over 60%. Ramesh's portfolio, supercharged by the additional units purchased during the crash, crossed Rupee 1.04 crore in February 2023, 14 years and 2 months after he started. His total personal contribution over those 14 years, approximately 57.6 lakhs. The market's contribution through compounding and growth, approximately 46.4 lakhs. At 46 years old, Ramesh had a 1 crore corpus, was still employed, still contributing, and his portfolio was now growing by approximately 12 to 15 lakhs per year through market appreciation alone, even without adding another rupee. That is the point at which wealth begins to work for you instead of you working for wealth. Now let us extract the precise lessons from Ramesh's journey and map them to numbers you can apply today. Lesson 1. He started with 19% of his income, not 30%, not 50%. A sustainable percentage. If you earn Rupee 50,000, 19% is Rupee 9,500. Start there. Lesson 2. He did not chase hot stocks, IPOs, or cryptocurrency. His entire equity portfolio was 2 mutual funds. Simplicity was his competitive advantage over people who were constantly switching strategies. Lesson 3. He built a liquid reserve before increasing his equity SIP. This gave him the psychological and financial security to stay invested during crashes and even buy more during them. Lesson 4. He treated his SIP like a non-negotiable bill. His home loan EMI was non-negotiable. His electricity bill was non-negotiable. His SIP was treated identically. Non-negotiable. Lesson 5. He did not wait for perfect conditions. 2009, when he started, was the year after the worst global financial crisis since the Great Depression. The news was catastrophic. The headlines were terrifying. He started anyway because he understood that for a 15-year horizon, the conditions of year 1 are largely irrelevant. This brings us to perhaps the most important data point in this entire video. According to a study by J.P. Morgan,